Assalamualaikum warahmatullahi wabarakatuh to Madam Noraini. Today, we are going to present about purpose and basis of valuation for task 2.
Hi, I'm Nurshila Murhazelan. Rating or assessment is a form of taxation payable by the real estate owner on their holding, for example, residential, commercial, industrial, agriculture, and special property. Then, rating used by the government as a revenue sources for public purpose, such as library, public school, fire protection, park and recreation. Valuation list is prepared under Section 137 Local Government Act 1976 and it brings all holding not exempted from payment of rent. The content of valuation list is name of street or locality, holding is situated, second designation of holding at the name or number to identify, third name of owner or occupier if known, fourth annual value or improved value of holding. New valuation list shall be prepared and completely every 5 years or within a standard period determined by state authority with the same particular. For tone of list, this legislation, based on the concept that rateable value resulting from an interim valuation shall not exceed the level of rateable value in the valuation list. It allows a rateable value to be determined at a level below the tone.
Hi and Assalamualaikum. My name is Aliah Binti Bakar. So I will continue for the valuation approach that commonly used in rating assessment. The first one is comparison method, which is the rent is actually being paid for a property may be best guide to rating assessment. It is suitable used for properties such as office, shops, warehouse, and more. The comparison method is based on the direct rental and indirect rental evidence. For the direct rentals evidence, it is based on the actual rental of property and considered as the best evidence. For the indirect rental evidence, where the property is not let, the best evidence is the rent of an identical property. If there is none, it must be compared with the most similar property. Second is cost method. This cost method is applied when there is no direct or indirect rental value or reliable evidence from accounts or profit, which make this method to usually applicable to specialized industrial, public libraries, town halls, sewerage, and more. This method is done by taking the percentage of the effective capital value to get the annual value. The last one is profits or account method. This method is applicable when there is no rental evidence, where the contractor's method is inapplicable and there is element of monopoly. It is usually applicable in properties such as hotel, petrol station, cinemas, and more.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Fatin Nurjannah Binti Azmi from AP1155C. Today, I am going to explain about annual value. Definition. Annual value is estimated gross rent at which holding might reasonably be expected to let from year to year. The landlord paying the expenses of repair, insurance maintenance, upkeep, and all public rates and taxes from Section 2 Local Government Act 1976. Matters to be taken into consideration. In case of land, which is partially occupied or partially built upon, we have to use annual value or 10% of market value. Which is vacant, unoccupied, or not built upon, we have to use 10% of market value. Land with incomplete building, we have to use 10% of market value. And last but not least, land that have building that has been certified to be abandoned or unfit for human habitation, we have to use 10% of the market value. Next is annual value calculation. We have different formula for different method. If we are using comparison method, the annual value can be get when we have a gross rent per annum multiplied with price per square meter per annum. If the land is vacant, we can get it by taking the 10% of market value. If we are using profit method, annual value equal to gross annual rent. And if we are using cost method, annual value equal to market value multiplied with rate of return.
Assalamualaikum. My name is Afiqah. As for the improved value, based on Section 2 Local Government Act 1976, the price that the owner willing and not obliged to sell might reasonable expect to obtain from a willing purchaser with whom he was bargaining for sale and purchase of the holding. These improved value are used in Johor and Malacca. It was also said that improved value is in the same category with the definition of market value. As has been said before, Johor and Malacca are mainly the only states that use improved value as its basis rate, which also makes Johor and Malacca as the rare distinction home still using alternative rather than changing into using annual value. As for Johor, this act was provided under Section 28 Substitute 1 in Johor Laws Enactment number 118 with the statement that any rate or rates imposed under this part shall be assessed upon the improved value of holdings, which also act as the power to impose the rates under the Johor Town Board Enactment. Now I will be showing to you one of the example of calculation of improved value. We will be using cost method. The land area of the subject property is 1,540 square feet and the market value of the similar property is 280,000 ringgit. The rate of return is 2.6% and the purpose of the valuation is to be valued for 1 January 2021. For the basis of the valuation is improved value since it is located in Johor, and the principle of the subject property is Rebus 6 Tantibus since it is a single-story terrace house. The date of inspection is 2020. The term of the lease is for 1 January 2021. The method of valuation used as per said before is cost method. So as for the valuation, the market value is 280,000 ringgit. The formula in using cost method is land value plus building value less the depreciation, which equals to market value. The market value is equal to improved value. Thus, the improved value for the subject property is 280,000 ringgit.
For principle in valuation, we usually use Rebus 6 Tantibus. It is a Latin phrase meaning a thing stand. It exists using existing use value. The property must value in its existing state as it stands. That is as it is on the day of valuation assessment without taking into account what it was or what it will be. Thus, the value is expected to be true reflection of the market as at the date quoted in the assessment report.
That's all from us. Thank you.